All right, with that, let's go across to Ed Yardeni, who joins in. He's the president of Yardeni Research. Ed, it's been a big rally that we've seen from the lows in the US markets. The streets now looking to live with this uncertainty that was there, and that uncertainty itself is, slowly coming down. What will be the two most important things that you'll be watching out for when it comes to trade negotiations and, at the same time, the big spending bill which has been lined up?
Well, I think with regards to trade, it's pretty clear that the administration would like to get this issue behind them. They are negotiating, and there will probably be some deals announced, some major deals, maybe even with India in the next several days, and that will be a positive for stock markets in the U.S. and India and around the world. I think that there will still be issues, perhaps with Canada, but what we're watching is negotiating. We're watching deal making. Deals will be done. And again, I think the administration recognizes that they'd like to get trade behind them, and they'd also like to get the budget behind them. And I think they'll certainly do that the way things have just gone in the Senate. I think the important thing to realize about the budget bill is that what it really does is it extends the tax cut that was already in place. Without it, we would have had a rather large tax increase that it could really have hurt the economy. I don't really view this bill as being particularly stimulative. It's just not going to be a situation where we're suddenly slamming on the brakes. So I think that the two big issues that the administration has started out with are going to become less pressing, less immediate impact on the markets. And I think the markets are going to, especially in the United States, going to turn to second quarter earnings. That second quarter earnings season will start in April. Let's do that in July. I'm looking backwards instead of ahead. So in July, we will get the second quarter earnings outlook. And that should be interesting. I think on balance, it'll be a positive one, because earnings estimates have been cut back so much.
So Ed, on the whole, do you think the U.S. equity markets can move higher from here on? So far, despite all the noise in the background related to tariffs, whether it's the big, bold, beautiful bill, geopolitics, U.S. markets are at record highs. They've scaled back to those levels in record time. Just shows the remarkable resilience. So keeping that in mind, do you say more legs to go, run?
Yeah, look, everything you said makes a great deal of sense. We have the market basically back to where it was on February 19th. The valuation multiple is around 22, which is where it was back in February 19th. We've got earnings estimates relatively strong. And so it's as though, nothing really happened between February 19th and now. Of course, a lot has happened, but it's been a V-shaped kind of correction. It's been, in many ways, a normal correction, certainly with an 18.9% drop in about 48 days. What's been remarkable, as you said, is how quickly the other side of the V, how quickly we've recovered from that correction. But I actually just wrote a piece saying that we could be looking at a melt-up scenario again. I and others were saying valuation multiples are kind of high back in February, and here they are kind of high again. So I think the market's going higher on earnings, but I can't dismiss the possibility that we'll see some irrational exuberance and see that the valuation multiple goes even higher.
Hi, Ed. Always good to see you again. So where do we go then on the S&P 500? I think we were talking about 6,500 or thereabouts.
Yeah.
If we're going to be going for a melt-up, how much higher can it go?
Yeah, well, my most likely scenario, my base case, is still 6,500 by the end of the year. Even that is awfully optimistic, because the assumption is that the market will be discounting $300 a share in earnings next year with a multiple of about 22. So all that is optimistic. A melt-up would be a situation where we see the markets maybe still sticking with that kind of optimistic outlook for earnings, but getting up to 23, 24, 25 multiples, in which case we'll be looking at 7,000 by the end of the year, or maybe even more than that.
Okay, a quick word on the US economy, though. We had the PCE data that came out on Friday.
Yep.
That appeared to be pretty much in line. However, the core PCE number, that was a little bit higher. It looked a little bit hotter than what was expected. Well,
Right.
there are signs that, that there is some kind of slowing down if you look at the spending as well.
Sure.
How do you read the state of the US economy?
Well, it's kind of like tossing up a coin, and heads you win, tails you win. In the following sense, that if the U.S. economy is in a soft, in sort of a soft patch, something that's not going to last very long, and the economy starts to look better in the second half, which is what I think. I think the market obviously has been held down. The economy and the stock markets have been held down by concerns and uncertainties related to tariffs. We also had that whole DeepSeek phenomenon that kind of rattled the market. Those issues are behind us now, and I think the market and the economy can do better in the second half of the year, and so that would take the market up on earnings. Now, if I'm wrong, and the economy is actually getting fundamentally weak here because the consumer's retrenching, well, then the Fed put is still out there. The Fed has been saying that they are no rush to lower rates. They've been stressing that they are fundamentally dovish. They are planning to lower interest rates. They're just not sure when. So if we get a weaker economy, they'll lower interest rates, and the stock market will go up on that still further.
That's a wonderful analogy there. Heads, you win, tails, you win as well. On the way up, you have the earnings that will take the market higher. If not, it'll be the Fed that will take the market higher. In any case, the market is likely to move higher, is what your call on the US markets is. Let's shift focus to the emerging markets, as well as your call, if you have any, on gold and the dollar itself.
Sure.
We've seen weakness in the dollar as well as gold. Gold prices are about at their 1 month lows. Do you think the best of both of them is behind them? That's one. And secondly, if the US markets are doing well, what happens to emerging markets?
Yeah, let me cover those issues. Very important points. Emerging markets, I think, are getting a big benefit from lower oil prices. Certainly, India is getting a tremendous benefit from lower oil prices. So the bad news for the energy producers is great news for most emerging markets, other than the ones that export oil. So I think that's a big driver there. I think also the perception is that if this tariff issue gets settled sooner rather than later, that's also a positive, I think, for the global economy and for emerging markets. And they have been doing well. With regards to the dollar, I'm not bearish on the dollar. Everybody seems to be bearish. Maybe I'm being too much of a contrarian here, but the U.S. capital markets are the largest in the world. I don't think that the euro or the yen are candidates for becoming reserve currencies anytime soon. And I will not be surprised if we're pretty close to seeing a low in the dollar here. It's been really in a volatile trading range for a couple of years, so we're at the bottom of that range. If it breaks through down below that, I'll have to rethink what I'm missing. But right now, I'm not that bearish on the dollar. With regards to gold, I've been very bullish on the dollar, on gold, thinking we could get to 4,000 by the end of the year. And I think that's still possible. Right now, gold has seen some profit taking on the fact that geopolitical risks have come down a lot as a result of the ceasefire in the Middle East. But meanwhile, central banks of countries that don't get along very well with the United States are still committed to buying more and more gold in their reserves. And I think that keeps gold going higher. So I'm going to stick with 4,000 by the end of the year.
So if we get that right, you're positive the dollar, you're positive on gold, you believe that the gold prices can go to $4,000, and you're positive emerging markets as well.
Correct.
And you're negative oil.
Correct.
Got it.
And in emerging markets, you want to quickly tell us your view on India and if it's changed at all in the last few months?
Well, I think that India is sort of in competition with China when it comes to global investors looking for opportunities around the world. I think China's still got some serious problems here. we may see a resolution of just about all of Trump's trade issues, but the relationship between China and the United States is going to remain tense, and it's probably going to be reflected in ongoing issues with regards to trade. I think the relationship with India on a trade basis will probably be resolved very quickly, and we might get a deal here in the next week or so, maybe 2 weeks. I don't have any inside information on that, but the administration seems to be indicating that they're expecting some pretty big deals, and I think it would be a very big deal if we got a good trade deal between the United States and India. So I think India still looks pretty good. You know, the market's benefiting from lower oil prices. China does as well. But India's got a much better demographic profile. The English language is widely spoken, whereas in China, not so much. But India is more of a capitalistic economy than is China. So I think India continues to perform very well.
All right, so India over China, right? Because the argument is that at these valuations, maybe in fact China could be the near-term story. What is your take on that? India's a structural story.
Yeah, I've been fundamentally opposed to investing in China, primarily because it's not a free market system. I think they were moving in that direction, and I think they embraced capitalism for a few decades, and that's why they made so much progress with their economy. But in the past few years, they've really clamped down on free market capitalism. They've been much tougher in regulating business. This doesn't mean that they can't continue to grow and succeed with technology in areas like that, but it's not an investable area for global investors in the sense that the rules can really change just overnight.
Ed, it's been a great conversation. Thank you very much for joining in.